All right, we're live.
We're live. We are live.
So first time in a long time, we don't have a guest with us. That's by design. Nobody's missing from today's show. But you and I were talking about this. So we, after one of the more recent ones, we're talking about the question we always get is, why has Carson and the external buyer become such a force in the marketplace?
Yeah.
And I just did an interview with Investment News just within the last week. And this was part of the process. So the conversation started with, why have multiples gone way up? Which obviously a large part of that has been private equity money, but also firms like Carson have sort of driven the price up as demand has increased and the pool of buyers has increased as well. But what we've seen from that is the decrease in the ability of a junior advisor or a G2 advisor, as we call them, to buy the practice. And you just did a topic on this at the Carson Partner Summit, within the last month, right?
Yeah, within the last month. So, one of my favorite things at Carson is we bring all of our partners together, and we bring them together twice a year. We all get together and we discuss a lot of really important things and things that we kind of survey our advisors. What are they going through right now? What do they want to talk about? And M&A, we have a few different sessions, but one of my favorite ones this year came from one of the advisors who asked the question. And really what they wanted to talk about was, when I'm thinking about my succession plan, when I'm trying to plan out, number one, who the buyer is going to be. Is it someone that's already in my firm, a G2 that I've identified? Is it someone like a Carson? Is it someone that maybe I want it to be a G2, but they're not really in the firm yet? I don't know who it is, but I still have a long runway to find that person. They were talking through all those options, but really what they wanted to focus in on, and some of the feedback we got was Mike, I want to see the math behind the different succession options. Right. What does it mean to me? And I think this is where you and I kind of have unique perspectives, because we both head up different parts of the M&A team. For me, I work with all of our partners that are already here within Carson. And one of the best parts about Carson is that we have different ways to affiliate with us. So we have our partnership channel where you can come and join our RIA, but you still own your firm. So you're still affiliated with us using our platform. Exactly. 1099. And, but you still own your own firm. So, and then of course there's minority and wholly owned partners in it as well. And the best part about my job is I get to work with all of them. So whether or not we own a portion or all of them or none of them, I'm still there to help. And I think one of the most popular conversations we've had recently is succession and starting to plan for it. And what they want to see is, how does this look depending on what I want to get out of the transaction? And so I think one of the important things that I'm sure you talk to the advisors about, but I do as well, and sometimes we deal with it differently, is what do you want this to look like in the end? What is your ideal outcome? When you think 10 years down the road, 5 years down the road, what does the future of your firm look like? What's really important to you? And so what we did in this conversation with the advisors a month ago, when we brought everyone together, was we kind of ran through three main scenarios on different options for them with their succession and really what it means, which I think is an interesting way, because my number one goal for all the advisors I work with is I want them to make a very informed decision. Yeah. When there are so many options on the table, making sure that you know all those options, how they affect you, how the numbers change, how the firm looks after the deal is done, I think is really important. And it's only through looking at all the different scenarios and modeling them out that you can really go in eyes wide open to a transaction like that.
Yeah. So I joked on LinkedIn, we were talking about this topic, that we were going to do some fun math today. It is fun. It's fun for nerds like us, but I think it's sobering too. And I think when we go through an example, it makes a lot more sense why you have seen firms like Carson step up to the plate and been a potential succession solution for advisors where there is just a wildly misaligned expectation around value and what maybe that G2 advisor can afford. Before we dig into the math, though, we should quick commercial. Carson is not going to move away from the 1099 channel. That is a huge selling point for us. The fact that we are able to meet an advisor wherever they're at in their life cycle, whether it's 1099 partner, maybe even before that from a coaching perspective. And then eventually, as they look to sell that practice, we can bring them on under our W-2 model and buy that purchase outright. And I think that's unique. Maybe not, we're certainly not the only one that does that, but I think we are We are a firm that uniquely was built on that model. We were not designed to be just purely acquisitive, nor were we designed just to be purely 1099 and 1099 focus, or that RIA, independent contractor focus. And I do think, before we kind of dig into this too, this is unique in that there's going to be more and more solutions where it maybe is a little bit of a hybrid, and maybe we don't get it to today, but at a future one of these episodes, we should talk more about what would it look like if somebody is mostly W-2. So most of a firm or an enterprise we're going to bring in is W-2.
Yeah.
But there may be some 1099 optionality there as well. And that's where I think it gets even a little bit more exciting, because that's a different solution, or maybe even a different approach to M&A.
That's exactly right.
You're right too, in that we focus on different areas. So obviously you are focused almost entirely internally. We've got those partner firms. Maybe some of those we already have some level of equity in. Sometimes we don't at all. Whereas for me, most of the time I'm dealing with a process. So I'm working with an investment banker that advisor has gone through this math exercise. So they sort of know why they're going to need a firm like Carson or one of our competitors to step up to the plate. So this is going to be fun for me, because this is different than what I typically see, and that they've already sort of gone through this process.
Right. At that point, when they come to you, they've decided that the external buyer is likely the solution, right? So they've kind of probably gone through the first two. Alex Littleton on my team, just a fantastic individual who is really finding his niche with helping a lot of our advisors. I love the way he phrases it. What he says is Mike, really, you and I are advisors to the advisors. We really try to help them see all of their options. And we have helped firms. We have helped father-son teams do succession. So a father-led firm selling to his son, and then the buyout process of that. And when you talk about family dynamics as well, that brings in a whole nother mix of things. And again, that was them selling, but we helped with valuation and structure and making sure that that son wasn't going to be too underwater and under too much pressure as you went forward, but the price was reasonable. We've helped non-family G1 to G2. And then we also, the majority of our transactions are with Carson. So is Carson the right solution? But Alex and I always start with, what is the right solution and what's right for you? And then let's look at the math.
It's a great way to phrase it too, because you're right. I mean, that's how M&A started at Carson, was as more of that advisor to our partners that were already on platform. In many cases, doing their own acquisitions or tuck-in opportunities. So you've seen every step of this M&A program at Carson kind of just explode and turn into now what it is.
Yeah, for me, my favorite is when I see a partner firm come in and join our team, and Bobby Steinow and Nick and Alex and I, we help them with their own transactions when they're the acquirer. So they're going out and sourcing, they're working with our business development team to find those opportunities. So they're doing acquisitions, their enterprise value is growing. And you have some firms, and we had a firm that came in and joined us at 160 million, grew to 1.2 through acquisitions along the way over the course of about 6 or 7 years. And then, in the end, what they decide is that they're all going to stay on board, but that selling to Carson makes a lot of sense too. So we end up doing 100% acquisition. I call that almost like the full firm life cycle at Carson.
We're talking about you, Mark.
Yeah, we're talking about Mark. Just so some fantastic firms. And what I love about my job is, again, I get to help them with every step of that process going through. So it's been a lot of fun. When we start to dive into the three different options, I kind of can equate it to, Michael, pretend I'm your realtor and you're selling your home. If I'm your realtor and I came to you and I said, Michael, we have 3 offers on the table. We have one for 600,000, one for 700,000, one for 800,000, and you should consider them all. Your response might be a little bit confused. It's like,
why are we even talking about 600,000 or 700,000?
Exactly. Why are we even talking about those? Why would you tell me, as my expert in this area, that I should consider all 3? And really what it comes down to is, I could tell you, well, we all know that terms are really important in deal structure. It's not just the overall amount, but there might be some other factors at play. Michael, you might tell me that, your grandson is actually, wanting to buy, and he's one of the offers on the table. Well, how important is it for you that your grandson live in this house after the fact? You might tell me that, hey, Mike, I'm willing to take a larger dollar amount if it's, spread out over a few years. I'm willing to take my money over a few years versus needing it all up front. Or you might tell me, hey, Mike, a middle of the road approach in terms of overall value, but me getting my money more up front is actually the most important. The reason I break it out that way is because actually that's it relates pretty well to some of the options on the table for the advisors. So when we met as a company, last month, we were all in this room and we were talking about the three options. The three options I laid out, and again, you kind of have to put some parameters and some fictitious numbers around this. But I made up that there's a firm with roughly about 600,000 of EBITDA, right? And they're looking to sell. And they have three main options in front of them.
And we should clarify just for, again, new listeners that maybe don't do this all day. EBITDA is bottom line cash flow. So that is all the revenue to the firm minus all the expenses, minus owner compensation or staff compensation results in bottom line cash flow.
Yeah. One of the first questions from a very savvy audience member was, well, okay, Mike, so what's their revenue? What's their AUM? I said, I took all that out just because, really, let's just focus.
Easy to manipulate,
right? We're not going to get into fee charge and all that, but we really want to focus in on the succession options. So the three options they have in front of them in this fictitious scenario is the first two options are they have a G2 in the office and they really want to sell to that G2. The final option is going to be selling to an external party like a Carson. And when you look at the three options, the first two involve the G2 as the buyer, but we do it in two different ways. When I'm talking to a lot of my advisors, a lot of them are asking questions like, hey, I have a G2 in the office. Do I need to give a discount to that person to buy in? Should I consider seller financing, or should I have them go get a loan from a bank? And the list goes on and on of questions. And I say those are all fantastic questions. Let's talk about it. So when you start to look at the options for the G2, you really want to look at, I think FP Transitions coined it like the affordability multiple.
Right.
And it's not that you're giving them a discount. It's what can that G2 even afford to buy? So if I want to make this even an option.
Because they're two very different things.
They're two very different things, right? That G2 is going to have to rely on the profitability of the firm and maybe even cut into their own take-home pay a little bit to afford to buy this firm. So as they're looking into that, they're saying, okay, as the future owner, what are the cash flows we're seeing right now in the business? When I am 100% owner and I'm running this business, am I even going to be able to afford whatever type of note, whether it's seller financing that I'm paying to the buyer or to the seller, or is it, financing paid to a bank? I need to make sure that I can afford it. And so we start to talk about these things and we start to say, okay, let's pretend in the first two options that selling to this G2 is really important to you. And that's fantastic. And I've worked with a lot of advisors who that's been a very key point to them. And it's very important for the G2 as well. So then we say, okay, let's look at the two different scenarios, seller financing versus bank financing. And when we broke down the math, a few things come to mind. Number one is the interest rate. Okay. One of the benefits from seller financing is that you might be able to give that G2 a little bit of a break on the interest rate as compared to where the banks are at today. Interest rates are all over the place, but if we say, roughly right around 10% nowadays for the interest rate, maybe you as a seller, maybe you can come in and give them a 6% interest rate. The reason as a seller you might be okay with that is because now you're capturing that interest instead of that going to a bank. And that's kind of that's a pretty big point here from bank financing to seller financing is that the seller is going to capture that interest. However, what you're going to see is you're going to have to give an extended timeline to them. So we're seeing typically on seller financing, anywhere from 7 to 10 year deals. And so you're saying, okay, I'll take my money over 7 to 10 years. When you compare the three options of seller financing, bank financing, third party, oftentimes the dollars and cents of it comes out to be that the seller financing might equate to the highest dollar amount in overall consideration because you're capturing the interest and those sort of things. But what that doesn't take into account is that you have received that money over the course of 10 years.
Or longer.
Yes. And so that plays a big factor, right? Time value of money and what you're going to do with that cash when you receive it. So it's not always apples to apples. And you really need to look into that. So again, and this is why it's important that we have the conversation with the advisor, because if I just put those three numbers in front of you and said, this is the highest dollar amount, but we ignore all those other factors, it can be deceiving. So we talk about that and we dive into, estate planning and tax planning and all of those sort of things that come along with it. But when you look at the math, that could be the most when you look at the Excel sheet in terms of dollars and cents.
Yeah. So it's fascinating to me. And I should say I was at Fidelity Inside Track last year, and John Fury from Advisor Growth Strategies did a breakout session on this exact topic. And it was when it came down to the seller financed G2 buying in, it's not always just the affordability. It's a time and a planning issue.
Right.
So the challenge is, let's just say seller finance makes sense and the numbers all sort of work out over 10 or 12 years. The challenge is most of the time, what we're seeing is advisors aren't starting this process 10 to 12 years away from retirement.
Exactly.
They're starting this 5 years from retirement. So the math may have worked out. They've just advanced too far into that plan for them to actually enact something like this.
Exactly. No, that's spot on. And then let's dive one level deeper. So in this example, we talked about this firm has $600,000 of EBITDA.
Right.
We're going to put about a 9 times multiple on that, right?
Yep.
Just for this equation, that's about $5.4 million of purchase consideration. When you look at dividing that out, and we did a 10-year seller financing note, remember this firm has $600 of EBITDA, right? $600,000. The annual amount that G2 is going to be paying to the seller is about $719,000. And that's at a 6% interest rate, right?
So obvious, but more than the cash flow in the business today.
More than the cash flow in the business, right? So, and this still might work. You still might find some things. You might go part seller finance, part bank finance. You can play with some things. You might lower the interest rate, right? But again, these are all things that we want to go in eyes wide open, because from the seller, they're like, oh, it'll be great. The G2 is going to buy it. I'll give them a discount on the interest. It'll be fine. When you really start to break it down, are they going to be okay? Is that going to work out? And you need to have the G2 as part of that conversation too, and what they're looking for. But at the end of the day, in that scenario, after you calculate all the interest, right, it's about $7.2 million in total consideration that went to the seller, because you're wrapping in that interest. But you receive it over 10 years. Is that even going to work? And is it going to work for the G2? But it could. Okay. So, and again, when I had this conversation with the advisors in Omaha, I told them, I said, I'm not trying to sway you one way or the other, right? What I'm trying to do is, let's just show you how important it is that we have the conversation and really map out all of the options so we can go in eyes wide open. Yeah. Right. I keep saying that, but it is true. Make the right choice for you. So let's go to option 2 here. So option 2 was, again, the G2 is going to be the buyer, but now instead of seller financing, the G2 is going to go to a bank and get a loan.
And generally speaking, we should mention, it's not usually your local credit union or bank.
Correct.
Nowadays, when we talk about this, because they don't often understand intangible assets or personal goodwill or financial advice. So now more often than not, we're talking about an Oak Street, PPC, Live Oak, Skyview, one of those.
Exactly
firms.
right.
Yep.
Yeah. You're going to them.
Digital lender focused in our space.
Right.
Yeah.
Right. So when we talk about the affordability and the multiple we put on it, again, I put it 9 times on here, because that in general, when we're looking at the numbers, okay, 9 times seems reasonable. So valuation is still at that $5.4 million. Now, some important things to think about with bank financing. Number one, typically the bank's not going to lend you 100% of the purchase consideration, potentially 80%, right? And this is where you need to talk to those different lenders and see what they're willing to do. But what that means is 20% of the consideration needs to come from some other means, whether it be the G2 savings or maybe the seller finances that 20%. But in this example, that's about $860,000 that G2 needs to come up with in a different means.
It's a hefty down payment.
It's a hefty down payment. Exactly right. But again, could it work? Potentially. Yeah, it just completely depends on the situation. The benefit to the seller here in the bank financing is that they're going to receive their money more in that upfront bucket. So depending on the structure, you're probably going to have about 60% coming to you up front. You might have a few retention payments in there, looking more and more like one of the typical transactions we would see. And so you'll probably likely receive it within 2 or 3 years, right? Probably within 24 months, you're probably receiving
generally speaking. All the consideration.
Exactly. So again, now we're checking different boxes. Now you were able to sell to the G2. Now they're the owner. You got your funds up front, but now that's going to look a lot different for the G2, because the interest rate is going to be a little bit higher on the financing.
Definitely.
Right. So maybe we jumped from a 6% that you were offering up to that normal 10%. And now, that obligation on the buyer is a lot per year. But the overall to you, we're looking more back around that $5.4 million in total consideration. So I think these are just really important things to consider and have a conversation with the G2, have a conversation and map them out to see what makes the most sense. And even just having conversation with the lenders to see, is that going to be a possibility and is that going to work? Yeah.
And the earlier, the better, obviously, because I think where we see situations really affect client attrition or client service, I should say, is when maybe the G2 had the expectation that he or she were going to buy in from the get-go. The math doesn't work or the timing doesn't work. And now the G1 has, 5 years or less before they're going to exit the business. G2 realizes that the math is not going to work out, doesn't have a chance for equity ownership. And without a firm like a Carson that can figure something out, then they're left with a sour taste in their mouth.
Right. And so, from that buyer's perspective, they were looking at their options and they said, okay, I need to come up with roughly, close to $1 million up front. And then that annual debt obligation is about $860,000 in the bank scenario.
Yeah.
And that's because, typically those are going to be 7 years, not 10. So we just jumped from them trying to look at $719,000 in the seller financing to $860,000 a year now.
Right.
Okay.
Higher interest rates, less time to do it.
Exactly. Yeah. Right. So again, these are just the factors that we have to look at and play into. Could that still work? Definitely. We just, again, go in eyes wide open. So when we have that conversation, I think you just hit on a really important point. This third bucket, this third option, which is the Carsons of the world, right? And is that a good solution? What I love about how we have approached those transactions, I've had it happen in the past where we've actually gone to do an in-person meeting, and options 1 and 2 that we just talked about are actually the front runners. And that has been how they have been planning for the last 10 years is I'm going to sell to my next generation owners. Maybe there's a few of them. And so we're like, awesome. Love to help you with that. And we lay out all the math.
So you're doing this math problem in person
in the conference room, right? Man. And we have the seller and we have the buyers in place. And
you see the eyes just getting bigger and bigger for the G2.
For the G2 and even the G1, the seller's like, I didn't really realize how this was going to look to them and how it was going to be. And so we have had to pivot to, okay, we know what's important to everyone, right? We want G2s that still have some sort of skin in the game. They love that equity. They want ownership. We have the seller who wants their liquidity event, but we want the math to work really for everyone. So what we've been able to do is now we're going to start shifting into this third bucket I talked about where it's Carson. Is there a solution where a Carson could come in and we can accomplish all of that? Mm-hmm. And what we found is that there oftentimes is a way to accomplish that. When you think of things like rollover equity into Carson and allowing maybe G2s to buy a little bit before, even if they're not buying a large chunk, right? When they look at that, but okay, maybe I buy a little bit before the sale. And then when we come in, we can either get them cash for that or
rollover
equity as part of the deal. And so we start to get really creative on the solution on the Carson bucket side. So from the seller's perspective, the Carson bucket side looks very similar to the bank financing in terms of they're likely going to get their proceeds within 24 to 36 months, right? There's going to be upfront, there's going to be retention and possibly even some growth. But what you see in that is oftentimes the multiple is going to be a little bit higher, right? Oh, yeah. And again, just going back to the affordability thing, not that seller was trying to give a discount to the next gen, but just from a math perspective, to make it work, they were going to have to discount it a little bit. So where we might have been looking at a 9 times, now we're looking at a 10.5, or maybe even a little bit higher. So as the seller is looking at these 3 buckets and they're looking at our spreadsheet and they're looking at the very bottom number, right? Total consideration. This last bucket tends to probably be somewhere in between the first 2 options, but they're getting their money more upfront. And what's really important to them is, have we solved for ownership for the next generation advisor? Right. And typically we have in that scenario. So it's interesting though, you apply the same exact fact pattern to each. And when you lay it out this way, it really does allow you to kind of dive deeper in the conversations on what is most important for you with succession. Yeah. And making sure that everyone is kind of at the table having that conversation is what I think is probably the most important piece of all this. Yeah. So, and it's interesting. So at the beginning of this, we're talking about selling a house and use the example of 600,000, 700,000, 800,000. We should note that more often than not, you're not going to see a tight spread like that between these 3 buckets. Correct, yes. So I was, David DeVoe and DeVoe and Associates did, I think they released a white paper within the last year and a half. And I mean, it was like 30% plus is usually the discount a G1 is going to take if they sell the entire business to a G2 below street value. So when you think of option 3, and we were talking about if a G2 were to buy in a meaningful or a significant share, but not the entire thing, and we're stepping in to fill that gap. Now G1 is maybe not taking a 30% discount on the entire business. They're taking a 30% discount on 5% of the business or on 10% of the business or whatever works the best for them. That allows them to maybe give a little bit of a break to that G2 to buy in ahead of time. Yes. So they're on the cap table prior to us stepping in. And then they're immediately going to see the increase in value in Carson stock by holding our equity. Right. And in that third bucket too, when we look at the numbers, we haven't considered any upside.
Right.
When you're talking about that third bucket, like with the Carson side, there's typically going to be a growth component, right? That go get where you can even go above and beyond the numbers that we've seen, the compensation level, and then the rollover equity, right? What is that going to do? In the first two options, that seller has fully kind of cashed out, and the upside on equity, it doesn't exist in its normal nature that we talked about.
Right.
But now, if you have rollover equity as part of it, that can really change the numbers out a few years.
Yeah.
When you're looking at projections on where that equity is going to go, and because likely that seller is staying on for a period of time, they're not selling and right away exiting.
No.
Especially for the conversations that I'm having with the internal advisors. Right. So that rollover equity and the projections on that, and of course you want to be reasonable and look at it, but it can really change the math. So again, it's everything we've talked about, all the caveats we've talked about with rollover equity and these pieces. They're just more and more variables that we start to plug into the equation.
Yeah.
And really try to get to a model that allows that person to see all the options and all their glory, and how it affects each and every single individual.
Yeah. And you can see why, as a business owner, option 3 with some level of equity going to G2 would be so attractive.
Yes.
You solve the problem of your grandson not needing to buy the entire house,
right.
But part of it, or a portion of it, the metaphor breaks down when we start talking about an external buyer. They're going to buy it and you're going to rent from it, but whatever it might be. But they're getting a meaningful piece or a meaningful slice that property should appreciate faster than it would have prior to a transaction.
Yes.
And that's always a bet, right? That a seller is making, is that if I'm exchanging equity, I am betting that a Carson is going to appreciate faster or grow faster over time than I could have on my own.
Right.
Which I think historically we can say clearly, yes, that is accurate.
Yeah.
So it's interesting. And I think that's why you have seen firms like Carson take such a more active stance in M&A. It's not necessarily just about acquiring assets. It's about acquiring assets. It's about acquiring talent. It's about helping solve for specific issues just like this that our own platform or 1099 advisors were having every single day.
Yeah. And I think one step further, the reason I love Carson, how we've modeled it, is you get to choose which path is the right one for you. And it's almost like you and I get to fight over who gets to work with these advisors, because either they do it on the front end and you get to work with them and they have an amazing experience, or I'm like, great, if you want to join as a partner, I'll help you with all the other aspects leading to that in the future. Yeah. And it's like a choose your own adventure. And we really will help whichever door you choose, will help with that, which is what I love. That we don't have to say it's W2 or nothing, right. It's sell 100% or nothing. It's let's look at all the options and let you do really what you want to do. The find your freedom thing is really true. It is. And I could give 50 examples of how different firms around Carson have done it different ways, and have accomplished it. But it's unique to them, and it starts with my first conversation is, again, that ideal outcome. What is ideal for you? What is ideal for your D2s? And how do we want to structure this? Right. I was just there are situations too where we'll have a conversation at the front end, and the response will be, it's not in your best interest to sell anything right now, because there are financial things that we need to take care of ahead of time to right size the business and make sure you are in the most attractive position possible to sell. So we have heard over and over again, and we've talked about, organic growth rate is the single biggest driver of valuation. And if we were to look at a firm that is that melting ice cube, sometimes the conversation is, hey, we shouldn't be buying, nor should you be selling. Rather, come on as a partner, help you, or let Carson help use or supercharge that organic growth, put you in the position where it makes the most amount of sense, so that in 3 to 5 years, you can show that track record. And now when you approach the market, people are going to apply that growth rate to the valuation and sharing the credit for that with you. Yes. So it makes way more sense. Completely. And there are even some scenarios I always want to tell advisors, it's okay when your plan changes as well. Yeah. I have seen multiple times, especially when you add family in the mix, but even not, where in the mindset of the seller, of the founding member of the firm, is that they are going to sell to their son or daughter or G2. They want them to take over. And then we start to get into the conversation, and that's not really the ideal outcome for the G2 advisor.
Yeah.
And the seller has always thought, well, why wouldn't they want to own, right? Why wouldn't they want to own 100%? They should be chomping at the bit for this opportunity. And then when that changes and they find out that's not the case, it kind of can sometimes throw off that founding advisor. And they're like, man, this plan I had in my head for my firm is changing. That's okay, right?
Yeah.
We can, because again, we have a lot of different ways we can accomplish this. And that's why I always do think first having a conversation with the founding member of the firm, the seller, but then really making sure that those G2s are part of the conversation. And is this something that they want to do? They want to,
that's a great point. Like the affordability thing is important, but does the G2 even want to take that debt on? Exactly. Even if they can afford it, do they have the entrepreneurial mindset to do something like that?
Yes. Taking the debt on is one thing. When they look at what you do on a day-to-day basis, does that look attractive to them?
Right. Can they sleep at night knowing they have debt service like what you outlined?
Yeah. Or a lot of them want to be really good advisors, being the CEO and handling HR and the bookkeeping and everything that comes with being the owner of the firm. That might not look as attractive to them. So that can change. That conversation can change over the course of 1, 2, 5, 10 years. Even if it's been something that looked good to them before. Maybe now they're at a different stage of life. Maybe now they have a family and kids, and now their time, allocation and work-life balance needs are a little bit different. So there are a lot of reasons why that conversation changes. Yeah. But again, that's why we look at all the scenarios to see which one's best and best at that point in time.
Yeah. I mean, I think it shows again why it's so important too, when we talk about having second generation talent, it's truly across sort of the advisor lifespan. So if you are, let's just say 55 or 60, and you're looking at a transaction, your G2 can't be 23, 24 if you're talking about bucket 1 or 2. Like they don't have anywhere near the financial wherewithal to take on that level of debt or to run a business. Likewise, your G2 maybe can't be 55, 56. Like you need spans in there. You need to be planning ahead for the future and have different levels of both that affordability scale and also that age and wisdom and experience scale, so that if you are going to sell internally to a G2 or a G3 at some point, they're going to be able to keep that thing going forward and growing in the right direction.
I heard one advisor was just telling me about this about 2 months ago. And they said, Mike, I think I've done a really good job. I've set up my firm where I do have an advisor in each generation. Yeah. And it's something that a lot of advisors, it was kind of like, it's new to me to hear that from an advisor that they really focused on that, but they did. They had someone in their 70s, someone in their 60s, 50s, 40s, 30s, even down to the 20s. Yeah. Right. So they had filled every single generation. And he was like, well, it's because that adage is true. The average age of the client is typically within plus or minus 5 years of the advisor. Mm-hmm. So if we're constantly trying to have good organic growth, you kind of want those differing ages and different generations of advisors to help with that. He goes, plus what I've learned is from a training perspective, the mentorship that each level gets from the level above them and the level above them has been fantastic. And the training just naturally happens when you have all those different.
That makes all the sense in the world. Yeah. I mean, you think about it, just an average book of business at some point, God forbid, clients actually want the money they spent all their life working for. Like yes. You're going to be in distribution mode. You have to grow just to sort of tread water. Yeah. And if you are now 65 or 70, you're going to, I would say, have a harder time appealing to maybe the folks that are younger in their career that are looking for an advisor that looks or feels a little bit more like them. Yeah. That is starting to build their own wealth in their own business.
Exactly. Spot on. And I think if this is something that you guys are looking at and starting to have conversations about within your own firm, give us a call. I really tried to let Michael do let me screen share this really nerdy spreadsheet, and we decided maybe not to.
I see it. It's on the table.
It's right here.
Right
it's right in front. Yeah. But these are conversations that we love to have. And I think our partners hopefully really appreciate that we're there when they want to have this conversation. But if it's something that you've been thinking about, look at firms that do give you optionality. And I think Carson is the best at that in the industry. And we allow you to kind of do it your way. Right? Yeah. Your freedom, your future with your firm.
I think it's an important topic. And I think this is a topic we're going to revisit a few times over the next several years, especially as market conditions change, as financing options change, as interest rates change, as volatility increases. I mean, there's all sorts of reasons that can make one of these different buckets more important sooner rather than later. Right. But I think to your point, the important part is pick up the phone, give us a call, have a conversation with an expert like Mike or with Alex, make sure everything makes sense and that you are going into the conversation eyes wide open, and that you are having the conversation with the G2 well in advance, so there are no surprises if the math doesn't work out.
Exactly right.
All right. So this was great. We will be back with guests like the next 4 months in a row. I think we have a few really interesting ones lined up, including an old favorite in 2 months. So excited to kick this thing back off in July.
Love it. See you guys then.
Thanks, everyone.